What's going on, guys? Lawsy back here on the option Brit. Just wanted to do a bit of a portfolio update for you guys today. Obviously, I've spoken a lot in my previous videos about what I've done, how I've done it, but I've not actually sort of given you a breakdown through the portfolio. So what I want to try and do is, when I've made enough plays, something notable to sort of make a decent length video for you guys to look at, I'll run through the plays with you so as you can sort of see what I've done, the thoughts behind it, how I execute them and how I enter them, that kind of thing. So last week was a massive week for me. I started with 25k and the idea was, hashtag road to 100k, and we broke that last week. As you can see up here in the top left hand corner, we're currently sitting on 101 we're down a little bit today. Something's kicking off in the market, but yeah, we're still happy. We're above that 100k. Things are looking good. We're happy with what we've got going on with our positions that you can see here are all open. Very, very red day today, but yeah, we're not worried. We're in win-win situations, all right? So, right, what I want to do is then, if we go back into our history tab here, I can show you pretty much the last 7 days what I've been up to. So you'll see here, look, Monday to Monday. So we'll go through it, and I'll sort of explain my reasoning behind the trades and show you what we've been up to. So if we go all the way down to the bottom here, we've got July 14th. Right, so to start with, what we did here is we sold some covered calls against our position in ACHR, okay? So we've got 200 shares of ACHR, which we bought at $8.34 per share, okay? Currently trading $11.87. It's had a bit of a tank today. Our positions actually looked a little bit healthier compared to what it did earlier. Here we've got our 2 covered calls that we sold. Okay, so there we go. 2 August the 15th. So we've got 25 days left on this contract, $12, which are now currently looking like they might be safe, but they weren't. Anyway, right. The idea on this trade is obviously if it hits our strike price of $12 or above, we're going to be obliged to sell those 200 shares at $12. But that doesn't matter because we bought them at $8.34, right? Like you can see over here. So we win on the stock appreciation. We're also getting paid over a trade price of $76 per contract. So obviously that's ×2, okay? So we get that no matter what. Now, the reason that covered calls can look a little bit perplexing to people on some occasions is that this actually shows that we're losing this trade, -64, right? We're not actually losing this, and it's a common misconception that people just don't understand what they're looking at when they're seeing the numbers. So we've already been paid this $76, but we've not effectively realized those $76 until the expiration date or until we exit the contract. And at that point, we can determine how much we've actually walked away with of that $76. So at the moment, this represents the value of that contract should we wish to buy it back. Now, if we were to buy it back, it would be at a $60 deficit. So we would have to give back the premium that we were given and $62 on top of that. Okay, make sense? Now, what happens is we've still got something called theta decay, all right? Now, this is theta. Theta is coming our way. This contract is gaining $4.52 every day, and it will speed up the closer to the end of the 25 days that it gets. So we're not losing this. The worst case scenario is that this will end above $12. This will still show we're losing, but we're not, because we're going to be given $76 ×2, and we're going to sell these shares at $12 a share. We're winning on both fronts. This does not mean we are losing on a covered call, okay? This means that it is working. Our money is working for us. It's appreciating still. We just need to let theta decay do its thing, and then we will either just keep hold of the premium as well as hold our shares if it doesn't reach the $12, or we will sell them at the $12 and get the premium as well, okay? So just so as everybody's aware of that one. It's a little bit difficult to get your head around, but when you do, it all kind of clicks into place and you just get it, all right? So yeah, that's that one. Right, okay, so on this one, guys, we actually bought back 10 cash secured puts that we'd held for a while on SoFi. So we sold 10 contracts for the $12 strike price. These obviously were never going to happen. We was never going to have to buy them at the $12. What happened with this is we bought the contract back and we actually realized a gain of $1,470 on this one. So this was a really good trade, went in our favor. Within a short space of time, I believe this was less than a month, we realized a $1,470 gain on those 10 contracts. So yes, very, very good one. Right, now what we've done on this next one with Palantir, we've sold 3 puts and 3 calls. netting around $2,000. You can see over here, 1,197 and 960 for the calls. 1197 for the puts, 960 for the calls, right? So just over $2,000 in premium. Now, this trade's called a strangle. We collect on the cash secure put side and we collect on the covered call side. However, we don't actually own the shares on this one because this is a delta neutral strangle that we're playing out here, which means that we have to manage this trade. Okay, we can't just let this one play out. Now, I'm actually playing this as though I want it to hit the 130 strike price because I'll happily buy the shares of Palantir at 130 if it drops to that, okay? The best way of visualizing this is if I pull up Robinhood Legend and go to Palantir over here, you will see drawn out on here. Where the blue line is, that's a representation of where the stock was trading when I sold these contracts, okay? So 180 is on our cover call side and 130 is on our cash secure put. We're trading smack bang in the middle of that, okay? So as long as it doesn't go up to or above the 180 or drop down to or below the 130 and it trades anywhere within this massive range, then we will just collect all of that premium at the expiration date, and that's that. All of our money gets, the capital that we put down for those puts and calls gets released back to us, and we're free to go and do what we want with the extra premium that we've collected, okay? So that's the liability that we've got with that one. So the idea behind this is we've got our puts here and we've got our calls. What we're looking at is the ETF delta, this column here, okay? So you'll notice that combined, we've got a negative 0.3. That is pretty much neutral. Delta neutral is what we call. That is where we want this to be. That means that we are in a good spot. Overall, at the moment, we've had this trade run in for 6 days, you can see over here. All right, and we are already $339 to the goods. This one, independently, the put one is worth 282 and the calls are worth 57. Now, what we need to do is make sure that the two independent deltas are very, very close to each other, because what happens is they negate their losses, okay? So if one was to run away, you never ever touch your losing side. So let's say, for instance, it pushes higher. This goes to 160 rather than the 150, 167 that it's at now. The delta will run away on the 180 call and it will be heavily outweighed. What we would then need to do or look to do is we would buy back the cash secure put and we would sell it to bring those deltas back in line, so as our net credit will always stay in the positive. Now, you're not always going to be looking, if you make this delta neutral strangle play, to run this to expiration. But as I say, these ranges that Palantir are in at the moment, I'm pretty confident that we're not going to hit either of them. But if we do hit the 130, which is more likely than the 180, then I'm happy to own those shares as well. So I wouldn't recommend anybody make this kind of play, especially naked, if you're not willing to buy the shares if the cash secure put gets hit. I've played it much, much safer on the 180 range. I've gone a lot higher. And I needed to keep that delta neutral, to keep them in a position where I'm comfortable with. And after 6 days, you can already see the realized profit on there. I could quite happily walk away with that, to be honest. But I think this will play out, and I think that we will stay within these ranges. And as long as we do, we walk away with exactly what I've explained to you guys back on the history tab here. We walk away with $1,197 for the cash secure puts and $960 for the covered calls. Should be a no-brainer, I think. I can't see it trading outside of those ranges, so I think we are relatively safe with that one, okay? If anybody wants any further explanation on the delta neutral strangles, drop a comment below and I'm happy to give some more information if anybody needs it, all right? So the next trade here is our Neo Leaps that we bought. I think I was holding these for around about a month to a month and a half, and they just appreciated so much. We ended up selling these and getting a $1,300 realized gain. So again, it had run up to a point where it looked like it had a roof on it for a while. It's probably got room to move a bit further, to be fair, but does seem to be stuck at the moment in that $4.50 range, which is pretty much where we sold these for our $1,300 realized gain. Okay, so yeah, a nice little play there. Next one we've got here is Grab. If I go to the positions tab and open up our Grab positions, we have 5 leaps. See, they've got 543 days remaining at $4.50. These contracts are currently worth an unrealized profit of $130 should I wish to sell these right now. But I don't. We're going to keep hold of these for a bit longer because I think Grab has fundamentally a really good company. It's probably got a lot more room to move on that, I think. The trades that we performed last week on Grab were these three here. So we sold 20 cash secured puts at $5, and we sold 20 covered calls, $5.50. I also purchased 2,000 shares to make these covered calls. On the covered calls, we got paid $640 for the covered calls and $440 for the cash secured puts. Okay, so we've placed these trades very, very close to the money. So the idea with this one is that we're looking to appreciate the stock value from 530 to 550 and hopefully get these shares called away so we can collect both sets of premium with no pressure from having to buy any more shares. And the shares that we did buy will have appreciated slightly, so we'll gain on the stock appreciation on that front as well. If it does happen to drop, we will still collect the covered call premium and we will still collect the cash secured put premium, but we will just end up having to buy a further 2,000 shares at the $5 strike price, which again, I'm happy to buy. That's absolutely fine. We'll just then run the covered call strategy again on 4,000 shares rather than 2,000. Again, a win-win situation. I don't place my trades thinking that there's a way that I can lose, because in this, I don't think there is. The stock is fundamentally strong and the strike prices are both at ones that which I am happy to sell or buy. So again, an absolute no-brain win-win situation as far as I'm concerned on that one. The next trade that we've got here, I had 2 covered calls running against my 200 shares of Hood, and Hood was going on a bit of a tear and I was getting a little bit concerned that they were dated out till December, and I'm not so confident anymore that Hood will be under 140 by December. So I decided to take a $95 profit still on the covered calls. I got out of them and I've made another trade today, which is a bit further up this, which we'll go over in a minute. But I was just looking to take a little bit of risk off the table because I think there's a lot more stock appreciation to go with Hood. I didn't feel like I needed to take the risk on that front. This here, this regulatory fee adjustment. So basically I've moved my trading account from Tasty Trade USA over to Tasty Trade UK, the IG platform. Exactly the same company, IG own Tasty Trade. It's just easier for me to transfer in and out money in the UK based one because obviously I'm UK based. So yeah, that's all that is, guys, okay? Next trade that we've got here, I had an NVDA covered call at 170, which was expiring August the 1st, which I rolled out, and to gain a further $10 in stock appreciation, I ended up having to sell this one for about a $1.90 loss, I think it turned out to be in the end. But again, for the appreciation of the $10 there, if it does get to the 180, it negates any loss that I took on that anyway. So again, another win-win situation, all right? So that's the main thing. Whatever trades we decide to place in this thing, we want to make sure that it's a win-win situation. We might be losing and having to pay a bit of a debit to get out of the covered call, but the stock appreciation way outweighs it, negates it, and in fact we do end up in the profit should that happen. So that's that one out of the way. The next trade that we've done today is we bought back 20 cash secured puts that we had running for SoFi for August the 1st, which were at $15. These were basically 90 to 95%, and we realized about $720 in premium on this one. There was about $80 left on the table, I think, in extrinsic value, which, you know, we pulled back nearly $5,000 worth of capital to be able to use back in our buying power, which was worth doing for me. So we realized that profit and we've got it to move on and place another trade, which we did, which leads us on to our final trade, which is our Hood covered call. You'll see now we've got our 200 shares of Hood, which we bought for a trade price of $73.55. Current market price is 105, so we've got a nice little bit of appreciation there. There's our stock appreciation, $6,298. And our 2 covered calls for July the 25th, which is 4 days' time, decided to go for the $113 strike price. I placed this trade about an hour ago, and you'll see it's $52 up already, what with the market taking a little bit of a spanking over the last hour. So we're already almost 30% into the profit on this one already, but I think we'll let this one ride out for the 4 days because I don't see Hood going to $113 anytime soon. But yeah, just to show you how this trade went, if I go into the options chain and show you this. This little brown mark down the center here is the expected move based on the stock. So over 4 days, the stock's expected to move in this range. You'll see the difference. If I was to go to say 32 days, you'll see how far it moves back out. Look. So it adjusts based on the day range. Okay, so when we placed this trade, our expected move range for the 4-day period was actually closer to down here. That's now changed because obviously the market's moved quite a bit since I placed the trade, hence putting us further out of the money, which means that we are into profit territories. So within 4 days' time, we should be quite easily able to walk away with our $176 premium for selling those 2 calls 4 days, which, yeah, you know, it's not bad going. That's pretty much all that we've got going on at the moment. We are just letting these positions play out. We've still got our leaps on SoFi, which are working away nicely, appreciating lovely. We've got some covered calls. They're a little bit underwater, although they have pulled back nicely today. We've still got 11 days left on these to sell at $20, but you know, we've got the shares to do it. The shares were purchased at the trade price of $14.20. So if we have to sell them at $20, then again, it's a win-win situation. We don't like to lose on this channel, so we make sure we cover ourselves any way that we can. And that's it, I think, guys. If you want to continue along with me, checking out my journey, watching what I do, if you want to offer any advice or have any questions, like, comment and subscribe in any order. And we will see you in the next update. Thank you very much. That's it from me. Take care. Bye-bye.